Joining me on set is Citi Wealth CIO Kate Moore. Welcome to you.
Yes, happy Friday.
And this is a new position, I mean, since we've seen you, so it's great to have you here. Welcome.
Thank you so much. It's been a really exciting little over 2 months in the new seat, and there's been no volatility and nothing to track and no changes to make in portfolios.
Don't you think people turn to you, they go, we're so glad you're here.
Yeah.
Explain to us what's going on. You go, well,
it's complicated.
Yeah,
Exactly.
How do you explain it?
Well, look, this is what I'm going to say. There is so much uncertainty, as we know, in both the earnings and the forward growth outlook at this point, that it's been really hard for us to get excited about adding to risk in portfolios. And that message was a little difficult to swallow in March, felt a little better during the initial drop after the April 2nd tariff announcements. And even after this rally, we're saying there's still enough concern we have about the back half of this year that we wouldn't be adding to risk. And we know some guests earlier on previous shows were talking about being at the top end of a trading range. I share that view, actually, and say it about around 22 times forward earnings. Earnings, by the way, that we don't have huge confidence are right. That we are like priced for perfection.
And so before kind of diving further into that, then what do you do with client portfolios? I mean, do you lean into fixed income? Do you look for alternatives? I mean, there's so many, private equity is seeing this kind of exodus and existential, all these questions right now. So I'm just curious if in a moment of saying, well, we're not so sure about stocks, well, there's also high inflation, you can't just go to cash. So what do you do?
Yeah, we have a lot of clients actually who have significant cash portfolios to begin with. For those clients, we're saying you don't need to put more money into equities at this moment, but we're hoping for better clarity as we get further into the year. For clients that have diversified portfolios that are really multi-asset portfolios, there are parts of fixed income we feel that can perform better. We kind of like that, 5-year and under duration.
So you'd go on the shorter end.
Yeah, the shorter end for sure. And we're increasingly seeing clients like across all regions want to hedge parts of their portfolios, look at alternatives and less correlated assets. Of course, that can be tricky on the entry points, especially when we're talking about some areas of alternatives. So we're just being very measured in our approach. And frankly, I have to say, as a wealth organization, our job is to be partners in wealth through all parts of the cycle. And sometimes that means just sitting with our clients and saying, this is not the time to add.
Oh, sure. And probably also saying at some points, it's not the time to panic either for those with a longer time horizon. And I take your point when looking for uncorrelated assets. But again, there's these questions about, well, are some of these private assets uncorrelated, or are they just not as, not marked to market, right? Like, does the correlation just show up with a lag? And I think that's where a lot of people who have really piled into those corners of the market are questioning that now.
Yeah, and we see that, of course, with a lot of endowments and foundations, long-term asset allocators for whom those types of investments were big anchors of their portfolios. I've been party to some of those debates outside of my day job. Yeah. And I think they're going to be ongoing over the next couple quarters.
Where do they go if they say, okay, 40% of private equity is too much? Where do you turn to? Is this an entry point for stocks? Well,
one of the risks, I think, is that even if you think that some of the private assets are not being properly valued, they're difficult to get out of, right? And so if people want to reduce their overall risk, they end up selling the liquid parts of their market, which are like, equities, U.S. large caps, for example, even if the fundamentals are better and even if we have slightly better visibility into some of those assets. So there's a lot of portfolio effect that can happen if people are wondering about the less liquid parts of their portfolio. And we're kind of watching for those actions, frankly, over the next couple quarters.
Yeah. So final question then is, where do you see the most area for opportunity? Is it even things like gold? I don't know if anyone's having discussions about Bitcoin and crypto, or if you go back to good old fashioned, kind of sector selection within equities, or is it international markets?
Yeah, I think this is the time where you want to stay really up in terms of your quality bias. And one of the places that we're doing a fair amount of work, frankly, is on the medium-term thematic. I won't say the short term because I think there's going to be a huge amount of, volatility around news headlines on tariffs and trade. But the medium-term thematic is, where are the places that can continue to sustain earnings, frankly, especially on the equity side, through all parts of an economic cycle. And here's what I will say. I think technology, and AI in particular, are existential for companies across industries. Even if their spend comes down a little bit from expectations in, say, January or February, these are not places that companies and industries can afford to step away from.